Financial stability analysis is the discipline of developing tools to measure and respond to systemic risk. And even though some media may not think much of it, watching a new field emerge is exciting stuff. The smart people engaged in financial stability? Well, let's just say they know their stuff.
My PhD was in applied mathematics.
My research is about measuring financial distress in the system as a whole.
There's a lot of stuff in between where you can actually quantify what that risk is and make the decision about if you think that trade-off is worth it or not.
The experts who do financial stability analysis have one shared goal: to prevent the next financial crisis.
The financial crisis revealed that the data available to monitor the financial system were too aggregated, too limited in scope, too out of date, or otherwise incomplete. 6 years after the onset of the crisis, some pieces of the financial stability data mosaic are now in place, but many more key pieces are still missing.
When it comes to systemic risk, we can't manage what we can't measure.
Financial stability authorities need to be able to measure when and where systemic risk is more likely to arise.
Researchers are developing new models that hold the promise of detecting risk before it builds into a crisis.
The research I'm doing is actually trying to predict banks in distress in advance, well in advance, so to give the policymaker time to take corrective actions.
It is important to be able to anticipate these conditions with some lead. Obviously, the costs of getting it wrong are very high and could be significant for any society.
We actually have a lot of financial data to analyze.
I think the data that's available right now is just overwhelmingly vast. And one of the challenges that we have found in our efforts is how to look at a small enough subset of the data that you can actually understand what you're looking at, but that it captures enough of the big picture.
A lot of the financial data we have is in bad shape, but don't take our word for it.
Financial data is really in a terrible state. It lacks standards. It lacks the representation in a way that makes it easy for bank managers, executives, financial policy officials, regulators, to basically use the data to understand what's going on.
We have information about exposures between the Canadian banks, but we also might have some information on exposures from Canadian banks to some international banks, but certainly not information on exposures between international banks. And to get a comprehensive view of contagion and systemic risk, we would need that data.
Tackling data sharing problems are some unlikely heroes from the worlds of cryptography and computer science.
Sharing of information, even with the regulators, is problematic.
Cryptography and some related fields have been thinking a lot about data sharing problems of one kind or another for many years. And they've developed some very powerful and counterintuitive tools. I feel these tools, have the potential to really change the way regulators think of these trade-offs between transparency and confidentiality.
Regulatory transparency can help market participants anticipate how financial supervisors will respond to risky conditions.
The regulatory transparency should communicate how supervisors will respond to situations that are threatening the financial system.
The financial system is constantly evolving. The good thing is that so are we.
None of these tools are ever going to be static or can ever be static, because to the extent that the financial system continues to evolve, and we know it always will, then our financial stability monitoring tools will also need to evolve.